How to use an LLC to protect your rental properties in 10 minutes or less. If you own a rental property or you're about to buy one, this video can save you from a lawsuit turning into a portfolio wipeout because an LLC can protect you. But most investors use LLCs in a way that looks smart and gets them crushed when they're needed most. In 10 minutes or less, I'm going to show you what an LLC actually protects, what it does not protect, and a simple setup that makes it hold up in the real world. Hi, my name is Toby Mathis, and I've been a tax lawyer for close to 30 years. I really work in tax planning and asset protection, but I've been working with Anderson Business Advisor my entire career. We have tens of thousands of real estate investor clients. I also own hundreds of properties between myself and with my business partner, Clint Coons, which you should check out his YouTube channel as well. It's really great. So I know what works and what's BS. And so I'll give you the truth from experience, not from some book. All right. So why do people use LLCs for rentals? A rental property can get you sued even when you did nothing wrong. Tenant slips, a guest steps on a nail. There's an actual case that I always think about. A deck gives way, there's a dog bite, there's a mold claim. We've seen all sorts of stuff. There's a fire. Had a bunch of those on properties. It's always kind of crazy. That 3, I think, over the years. I've experienced them all personally and while working with clients. So we know the situation. We call this inside liability because the risk is coming from the property. So here's the property. The risk happens there. Here's you. You're just minding your own business. You have your own assets. So we put the property inside an LLC. Why do we do that? Because it contains the liability. If you do not have an LLC, there's no containment. You'd be personally on the hook for anything that happened to that property. So if something bad happens here, if we don't have an LLC, guess what? They could take your money. They could take your home in some cases. They could garnish your wages. They can even take certain retirement accounts. So the goal is simple. Contain the blast radius, and that's what the LLC is used for. And an LLC just stands for limited liability company. If you say limited liability corporation, I'm going to make fun of you. It limits personal liability for things that happen inside the LLC. Keeps you separate from that. LLC owns the rental. LLC's on the hook, not you. And by the way, LLCs are created under state statute. So there's like 50 flavors. For real estate, we almost always use the state where the property is located. You kind of have to. So the idea is to confine whatever happens on that piece of property to that LLC to keep it from hurting you personally. And now let's compare that with outside liability. The liability is caused by you, or let's say it's a family member, so we don't blame you, but it's one of your kids. They get into a car accident. Or you have a business dispute, or you have a personal lawsuit that is unrelated to the rental. Well, what about your rental property? Well, here's the truth. LLCs almost always help with the inside liability, but they don't automatically protect you from outside liability. Unless you go to a state like Wyoming or Nevada, where the statutes make it next to impossible for someone who you cause a liability here, they can't take that LLC. So if you had a car accident and own a property in your personal name, people suing you could take away that property. We don't have an LLC around that thing, they could take it. They do have an LLC around it, they could try to take the LLC. If you use the right structure, they can no longer reach your rental. And that's why we don't do one-trick planning. We do layered planning. Back to basics. What does this LLC actually do then in plain English? If the property is owned by an LLC and you run it correctly, then a lawsuit tied to the property is limited to the equity in that property, not your personal property. The cash in that LLC, assuming it had a bank account. You're not just using your personal bank account. There's an insurance policy hopefully covering it. That's what they're limited to. The whole point is to isolate that property and isolate that liability. If one property has a problem, it should not take everything you own. It also shouldn't take your other rentals if you have more, which brings us to the number one mistake we see new investors often make. They bundle their risk. So they might put a whole bunch of properties in a single LLC. That's because it's easier, right? And let me translate what that means. They just grouped their risk on purpose. And if you have, let's say, 5 rentals in one LLC, and you get hit with one lawsuit, boom, we had an issue on one property. The plaintiff doesn't care which property caused it. They care what the LLC owns. You didn't build a firewall. You built a storage unit, right, for the liability. So here's how successful investors structure themselves. Almost all investors land in one of these. They'll use option A, one LLC for property. So let's say that we just put each one of these in its own LLC. So I wish sometimes I didn't use chalk, but you can see there's one property in each LLC. We just use a separate one. The best, the pros for it, I'll just say it's the best containment. Doing this, something happens here, it's limited to that. They can't take the other 3. The cons of it is there's cost, right? There's more administration, but it is the gold standard for real estate investors. And this, by the way, can be a nightmare if you do it yourself, because someone who has, the reason I say that is because I'm a tax attorney, and I've seen this over and over again over the years. If you're doing it yourself, it's very easy. You could have 10 properties, you set up 10 LLCs, and they all have a separate tax return. And those tax returns can be really expensive. So don't work with amateurs unless you want messes. I've seen accountants do this over and over again. 10 properties, 10 partnership returns, all being billed at $1,500 a year. Don't do the stuff like LegalZoom or the online do-it-yourself sites to do this. Make sure you're talking to somebody who actually knows it, because you get what you pay for in this area. You don't want to be defending a multi-million-dollar lawsuit with a $100 piece of paper. It's not going to go well for you. Option B, you group by risk and equity. So you might take, let's just say, high risk, high equity properties. I'll just call it high equity properties. You might just isolate those. Hey, I want to keep these off on their own. And then you take lower risk properties, you might group those. I have seen that work. And this is what people with lots of properties do. And I'll be honest, I've done this myself. I bought portfolios of 30, 40 beater properties at a time, where I knew I'd be keeping some and dumping some. And so I took them all in an LLC. And then I parceled them out eventually. Just remember that if you have, let's just say, 5 properties in an LLC, each one with $20,000 of equity, your exposure isn't just the $100,000. So you have 5 properties, $20,000 each, $100,000 in equity. But it's also the cash flow those properties are kicking off. It's still an option, though, and it's way better than owning in your personal name. It's a lot easier than doing in each one. So if you're doing a whole bunch of properties, sometimes people are doing that. Oftentimes with commercial properties, too. You're never going to own those together. We're never going to group those, but we might take some single families and put them in a few. Again, it depends on your scenario, which is why you actually have a conversation with somebody to see, okay, let me measure out the risks and opportunities. Now let's go to option C. Option C, depending on your state, is people will use a series LLC. Some states allow for them, and it allows you to set up a master series and then set up cells for each property. But it's not a set it and forget it. And some people think, easy, I don't have to keep separate books or records or anything like that. But that's not true. You absolutely have to. But series are also a little bit tough to bank, so it's understandable that they would want to cut corners. But those corners are bad news if you actually have to defend yourself in a lawsuit. So if you don't respect the separateness of your entity, don't expect a court to. So it's a mixed bag on series for me. And by the way, I know some of you guys care about privacy, so I'll just say a quick tease. You can do it. The LLC is not the best tool for anonymity. It is a liability tool. There are some states that allow the anonymity too, but if you want true privacy with real estate, you're going to use land trusts, and you're going to pair them with the right LLC structure. It's like milk and cookies, right? They go great together, land trusts and LLCs. They get your name off the property, and the LLC still holds that liability and isolates that liability, so you can be an invisible investor. And by the way, speaking of invisible investor, I will give you our free ebook. It's 3 steps to invisible investing, absolutely free. I'll put it in the show notes, or you can type invisible in the comments and I'll send you a link. Hey, now you know about LLCs. So I'm going to give you one last thing. Here's a quick checklist to make sure your LLC holds up. And if you want the LLC to work, then this is what I would do. Number 1, ready? Deed title into the LLC, or use a land trust to hold title and assign that beneficial interest to the LLC. Do not keep the property in your name. Same thing for liability protection. And by the way, you'll read about this in the free ebook. I'll make it really easy for you. Go through and read it, and you're going to see all this information again. If you formed an LLC but title is still in your personal name, you did not move the risk. It's still over here with you. It's not in there. So we got to make sure it goes over there. We need to retitle the property out of your name. When you rent the property out, make sure the lease is in the LLC's name too. Not you, the LLC. The tenant should rent from the LLC, not you personally. Create separate bank accounts whenever possible for those LLCs. I know it can get tough, and there are situations where it's not as important, but as a rule, especially when you're getting started, separate books, separate bank accounts, keep it separate. Make sure that the income goes into the LLC and the expenses go out, and that there is a paper trail behind it. Do not commingle. Don't pay the LLC expenses personally out of your pocket, then figure that you'll sort it out later. That's how lawyers argue the LLC is just you. It's called alter ego. Also, an LLC is not a replacement for insurance. Insurance comes first, the LLC comes second. Speaking of which, make sure you have a landlord policy, not just a regular insurance policy. You want to have liability coverage, but you also want to have an umbrella policy. It's like lawsuit protection. The LLC is a backstop. It's not a replacement for insurance. Be careful with your personal guarantees as well. The more you personally guarantee, the more you punch holes in that liability. You could still end up being on the hook. That's it. Pretty simple, but you have to actually do it. And if you want the exact framework to use that we use to help investors protect assets and reduce visibility, here's what I would do next. Download the free guide, The 3 Steps to Invisible Investor Strategy. It's free ebook. My partner Clint Coons put it together. It's absolutely fantastic, and it'll walk you through. And if you want to help or want to have help applying it to your portfolio, if you want someone to go through it with you and create a blueprint through you, well, when you download the free ebook, you'll get an opportunity to sign up for a free strategy session with the team. Links are below. They're in the show notes, or you can go into the comments and just type in invisible or I want the book, and we'll send you a link. So I'll also include a link to a recent video of what is a land trust and why real estate investors should use them, because that's the next layer to making sure this foundation is really strong. In the meantime, like and subscribe, and because this is stuff that nobody really gets taught until usually you look at it after you get sued, share it with people that you know that are real estate investors so we can make sure we can keep them out of trouble. Thanks, guys.